Hi subscribers and welcome back to the channel. Today we're going to be doing something slightly different. We're going to be having our senior and most experienced advisor, Jonathan Laws, joining us today to give his input on a few very technical topics. So the topic for today's conversation is, will defined benefit CETVs go up or down? Interest rates and yields explained. So Jonathan, if you could kindly start off by explaining to our viewers what interest rates and yields are and how they will affect our clients' future cash equivalent transfer values.
Hi subscribers. First off, if you might be able to hear, I've got the dreaded man flu, so I do apologise in advance if I stutter halfway through my answers. Key things when you need to look at when clients come to us and they mention about interest rates and yields is you need to remember they're not exactly the same thing. So whilst you might read on the headline that day, oh, the Bank of England's raising rates, what you have to remember is markets are future looking. And what they've done is they've already predicted or estimated what they think is going to happen with those interest rates. So what you look at is a yield, and what a yield is effectively modeling those interest rates out through the future and basically showing you the interest required to own that type of bond. Now, the interest rate ostensibly might be 5%, but the yield might be 6%, and that's because of an expectation of it going up or various things. There's loads of technical things you can get into about how they diverge, but essentially what you need to know is just because the Bank of England has raised interest rates or lowered interest rates doesn't mean that yields have been affected.
Yeah, pretty much. And how an important role would you say interest rates and yields play when a defined benefit scheme is calculating or recalculating a client's guaranteed cash equivalent transfer value?
The most important. So when clients come to us, they'll mention a lot of times, oh, the markets are doing really poorly. They're down 10%, but my CETV's fallen considerably more. They don't know what they're doing. They're investing very poorly. And in reality, what drives CETVs more than anything, more than inflation, more than investment return, more than economic growth, is interest rates and yields. They are the key driver, and 90 to 95% of any fluctuation in a transfer value will be because of those change in yields.
Wow, it's very how you say there, so 90, 95%, and is that based on sort of your experience in sort of seeing CETVs come through or reading online?
Yeah, but based on experience, but it's also based on mathematics. If you know what goes into calculating, which I do, typically speaking, there are two real inputs that matter: yields and inflation. And the impact of inflation, whilst it's very high, especially these days, a lot of the schemes are capped at 2.5%, 5%. So even if inflation was 50%, the impact on the CETV would only be using a figure of 2.5 or 5%. And actually, yields will be the main driver. And let's say if CETV fell by 20%, probably 18% of the drop will be because of yields, and maybe 2% will be because of a change in inflation expectations.
Mm-hmm. And for those clients out there who are thinking, oh, maybe I'm going to try and wait, or maybe I'm going to try to play the markets, what would you say are the other important factors that a client or their financial advisor need to be aware of if they're considering to hold off and get a future CETV?
I think the first thing you need to focus on is say to yourself, right, am I in the position right now where I want to look for a pension transfer? Do I think that a fixed annuity does not suit me? That's the first question you need to ask yourself. If the question is, yes, I'm looking to retire soon, or I have a specific need for a lump sum, or I've got ill health, whatever it is, now is the time to be looking, or at least starting the process, trying to, predict or play around, or, hedge your bets, or you think, oh God, it's fallen a lot this year, so I'm going to wait next year. It could be a good strategy, but history shows that it's very hard to predict CETVs. And a lot of times, if you're not really in a situation now where you're saying to yourself, right, I need a CETV because I want to transfer, but no, I'll wait 2 or 3 years, then were you really in a position in the first place to really need to be looking for a DB transfer? And the answer is probably no.
Yeah, so effectively, you're almost kind of saying that clients really should focus first and foremost on what their requirements are and what their needs are, rather than kind of trying to play around with CETVs.
Exactly. Focus on yourself, and then the CETV will play its part in the role of the process. And it might be the case that it's a really inopportune time and the CETV just doesn't make sense for you and you can afford to wait. But you need to be starting the process and articulating your goals and why you want to look at this and what you want to do in regards to now and in the future before you even think about trying to predict or make bets on where you think CETVs are going.
Very good. And have you ever had instances of clients trying to predict or time future CETVs and it going wrong for them?
Yes, I have dozens. Case in point, one that's kind of etched into my brain was a client at the beginning of 2022. So just for a bit of reference, you may know this, viewers, but transfer values over the last period, they kind of had a little peak in January 2022. And since then, with the inflation kind of remaining very high, interest rates have fallen quite precipitously. Now, I had one client who spoke to throughout 2021, was looking to retire at the end of 2022, had good other assets, ostensibly seemed to know what he was doing. He got a transfer valuation, but he was faffing about. He kind of let it expire, but it was fine. He thought to himself, right, well, I don't quite need to do it for another 6 months, so I'll just wait. He got a new transfer valuation. It fell by 5%, which I actually remarked on at the time was quite impressive, because at the time, other clients I'd already seen had already fallen considerably more than that. And the client had very good reasons to do it. But anyway, he said, no, I'm officially retiring or looking to leave work at the end of the year. I'm going to wait to then, and hopefully the CETV would have recovered by then. Now, I said to him, look, I can't predict CETVs, but with the way inflation's going and the fact you've already got a very good one, and as you said, you've got very good reasons to do it. The client said, oh, no. I understand, but it hasn't changed very much. Maybe it'll recover. Lo and behold, the client got back to me at the end of the year, and the CETV that had fallen 5% at the end of the year had fallen 40%. All because he thought because interest rates rose and he thought he'd be able to predict. The client was very switched on, but as I say, and you hear quite a bit, sometimes people know just enough to be dangerous. And this was case in point. The client was switched on, but unfortunately ended up shooting himself in the foot because he got it completely wrong.
Interesting. So ironic, you're almost saying that with the client perhaps having less information, he probably would have ended up with he almost certainly would have a higher CETV value.
Correct. The thing with defined benefit pensions is, and they are just very unique. There are very few people who truly understand how they work, and that's even including people in financial services. A lot of financial advisors don't have a clue about DB schemes. I'm sure viewers, you've spoken to other financial advisors. You might even have had a financial advisor or have one now. When your DB scheme comes up, they don't really seem to know what they're doing, or they just kind of poo-poo it and shoo it, stick it in the cash flow, but never really explain or articulate what's going on. So yeah, no, exactly, John.
Just to go further on that point, John, is that from experience of talking with clients and heard things that other financial advisors have said, or seen other financial advisors' reports, or where did that come from when you say that type of stuff?
No, yeah, exactly. It's from personal experience, speaking with other clients, speaking with clients who were previously advised, who had an advisor, now they work with us, or even reading trade articles. You read a lot of times at Financial Times, advisor articles, something like that, and it's quite clear that there is a big, there's a misinformation there, or a serious lack of asymmetric information, as they call it. And yes, they just really don't understand it. It is a specialist area. That's why you have to get qualified to do it. That's why you have to take lots of exams. That's why the FCA is very protective of it, because it is a very complex area, and there are very few people who really truly know how it all works.
And interestingly, when you've given that type of feedback to clients, what have they said when you said things like, it doesn't sound like the other financial advisor knew much of what they were talking about? Do clients like to hear that, or do they get a little bit defensive? Or
Right, well, I like to be quite Switzerland on that, so I won't necessarily say the advisor doesn't know what they're doing, But I would, to then know that the advisor, this is not their area of expertise, and you really need someone who is very well versed in that area. So, they might be fantastic advisors and do really good, proper financial planning, but they just do not know anything about defined benefit pensions or being able to help you if an advice works. And, their default position will be stay in your pension through thick and thin. Which could be very good advice, but they might have backed into that being really good advice because they never even looked at the other options. So yeah, that's what I'd say on that.
Fair enough. Likewise, the contradiction of that, do you have any examples of clients trying to predict future CETVs and then benefiting from it, i.e. getting a higher cash equivalent transfer value?
Not off the top of my head. I have seen clients who have decided to wait a little bit and it hasn't hurt them, where they were lucky that during a small period that they decided to wait a little bit to get a new CETV or weren't particularly on the ball. And during that time period, yields kind of stabilized. But no, I haven't had anyone recently try to do that, and that will be because it's logical that it hasn't happened because since 2016 yields have they've been falling, and it's only pretty stable, and then it's only really since the start of last year that they've started to fall again. So no, it's unsurprising, but no, most clients during that period CETV values were pretty stable.
All right, so what our viewers have been waiting for: where do you expect CETVs to go for the remainder of 2023 and into 2024?
Right, so first disclaimer, I cannot see the future, but if I had to guess, you'd have to say to yourself, right, where are we with yields at the moment? And the key thing driving yields, it's all over the papers. You'll see the Prime Minister and all of that, always talking about this, and you'll know about this from your shopping and all the other things in life, is inflation. Inflation is the key thing at the moment that ultimately is the reason why your CETVs have fallen so much. So you've got to say to yourself, right, where do we think inflation's going? Now, we know it's more than likely than not peaked, but it is sticky and it is staying around. So you have to say to yourself, right, there's a very good chance that where yields are now is the high. The other consideration as well is, can we go higher? Can the UK economy afford to go higher? Can mortgage rates, can commercial property, when those mortgage rates convert over, can the actual economy survive interest rates being that high or higher, and for how long? So you've got to say to yourself, right, personally, you've got to say, right, this is the peak, or very close to it. Now you've got to say, right, how long is it going to take for that peak to go from the peak down to a more sustainable, a lower level where long-term optimum, if you want to call it that. If I would say yields at the moment, long-term yields are about 4.6%, which is the highest they've been since the mini budget disaster back in October. So you've got to say to yourself, right, well, I think personally that there's a very good chance that yields will fall as the year progresses, as inflation starts to roll over, as the UK economy and other economies start to slow. Again, that's on purpose. The reason why all these central banks have raised interest rates so much is because they are intentionally trying to put the brakes on the economy, because they're worried the overheating and everyone going out and spending money is causing inflation to kind of be a never-ending cycle. So you've got to say to yourself, I think it's going to, they're going to fall. It's just a case of how much, how quickly, and to what level. Obviously, if it goes terribly wrong and the economy collapses and unemployment rate doubles or triples, then what you're going to find is it'd be fantastic news for people with a DB scheme who will want to transfer advice, because it very likely means interest rates will plummet. Perhaps not to the zero interest rates we had before, but definitely to a level that probably boosts CETVs considerably from here. So if I had to say, I think CETV values will rise as the year progresses. I don't predict any massive rises in CETV values this year. I think it's more likely the economy slowing, interest rates perhaps needing to fall to cater for that, where you'll see rates fall and CETVs rise in 2024. And that's how I kind of see it playing out.
Thank you. And would you say, finally, are there any considerations that our viewers and subscribers need to take into account when they're thinking about obtaining regulated and authorized pension transfer advice in, for example, the UK market and beyond the UK?
Yeah, so I think the main considerations you need to really consider are, am I in a position now where I do need DB advice? And if I am, can I afford to wait? And the big problem with that is transfer advice, or just ostensibly DB advice, is getting harder and harder and harder to obtain. That is true of people resident in the UK, and it's especially true of those resident outside the UK. It is getting more and more costly for DB financial advisors to provide DB advice, and it's not hard to see why. If you're a bit of a loser like myself, and you read articles on DB, you'll see very often the ombudsman will rule a lot of the times that any advice given to transfer was not good advice, and firms end up being a lot financially have to put the client back, whatever that means. And what it means is that the people willing and able and getting insured to do DB advice is continuing to fall. And even those that still have the permission to do it, the levels they're doing and the amount they're capable of doing, or the amount they want to do, is falling as well. So you have that consideration. It's just getting harder and harder to do. It's getting more expensive to do because of the cost of those insurance and just the cost in general of being a financial advisor these days. So you need to weigh up, okay, 2025, 2026 might be the optimum time to do it, or maybe it's worth me deferring and hoping that CETVs recover by then. But if you've got very good reasons to do it before then, and a transfer might make sense and help you out before then you do have a limit because or potential limit, because by the time you go and get that advice, it might be the case that you can't get it, or it's much harder, or there's more parameters. You've got to be a certain age, it's got to be a certain value, and this, that, and the other. So that's a very real consideration you've got to think about, and that is especially true for non-UK residents.
And just a couple of bonus questions on that then. What level do you think it could stop in terms of DB advice fees? Like, how much further do you think the market could go? Because technically speaking, if more and more DB advisors continue to drop out of the market, as we're seeing on a weekly and a monthly basis, how much more expensive could financial planning or DB advice get in the current market?
Well, if you see recently, we have a few firms we work with, or a few firms we used to work with, and they're raising prices 15-20% annually at this rate, which on the face of it isn't surprising with inflation running at double digits in the UK. But it wouldn't be surprising that what was a £3,000 report last year becomes a £5,000 report in a year or two, and very well could be a £6,000 or £7,000 report a few years after that. If you if you look at the trajectory of where it goes, Dominic, back when you started off, I forget the actual value of what it was, but it only
£750.
£750, £750, 5-6 years ago, and all of a sudden it's £3,500 now. If you extrapolate the same way, it'll be, I don't think this will be the case, but it'll be £25,000 or whatever it is in 5 years' time. So there's only one way it's going, and that's the same with all advice. You may have read online about this new consumer duty that's coming out that hopefully will be very good. It'll be very good for financial advisors like Cameron James, who do proper financial planning and do proper, value added for clients. But it is another layer of compliance, another layer of justifying fees, and a lot of firms, just won't be able to do it, or will have to jack up prices to cater for this.
Yeah, no, it's funny you mentioned the 750. I always joke about that with clients. I remember at the time thinking, God, how on earth are we going to proposition this to clients? How on earth are we going to have to explain they have to pay £750 for this special DB authorized regulated advice report? Clients are not going to pay it. seldom, by the time you explain it to clients and outline things, clients are happy to pay the cost because they understand the work that goes into it. And fast forward 5 or 6 years now, yeah, the average is 3,500, but obviously it can be higher than 3,500 if the client has a large multiple. So anyway, Jonathan, thank you very much for joining today. Really valuable. Subscribers, please like, share, and subscribe below to let us know you found this valuable. And also in the comment section below, this is Jonathan's first YouTube outing. So let us know any comments for Jonathan below, any questions you have for him specifically. We'll try to get him to respond to them personally. As always, everyone, take care with your UK pension assets.